How Rome's money destroyed its empire, and what it tells us today. When you think of Rome's collapse, what comes to mind? Barbarians storming cities, legions scattering, emperors being poisoned in their palaces, right? But in truth, empires usually don't fall from the outside, they rot from within. And the most effective weapon of internal collapse has always been money. Rome didn't just fall because of wars or corrupt emperors. The real downfall began when its money lost value. And the lesson from that story still applies today, because we're making the same mistake, just in a different form. Rome's economy was built on a silver coin called the denarius, minted around 211 BC. It was almost pure silver. Everyone trusted it. Soldiers were paid with it, merchants traded only with it, and ordinary people saved it. In short, the denarius was trust made of metal. The empire's power was tied to the strength of its money. Rome was strong because people believed in its money, and people believed in its money because Rome was strong. But running an empire isn't cheap. Legions, roads, wars, tax collection. The expenses piled up. Raising taxes would have caused revolt, so emperors tried another way. They diluted the silver content of the coins. Under Augustus, the denarius was 95% silver. By Caracalla's time, it was 50%. And under Gallienus, only 5%. A coin that was once pure silver had become a bronze disc, with just a thin silver coating on top. People noticed right away. The coins were lighter, their color different. Prices shot up. A measure of grain suddenly cost several times more. It was one of the first cases of inflation in history. Soldiers demanded higher pay because everything was more expensive. Merchants refused to accept the coin, preferring gold or barter instead. Villages and cities went back to trading goods directly because no one trusted money anymore. But the emperors didn't stop. They thought, what if we just mint more? If you're wondering, no, it didn't help. In fact, every new coin printed only destroyed more trust. By then, the vicious cycle had begun. That's what triggered what historians now call the crisis of the 3rd century. Wars, plagues, civil unrest, back-to-back economic collapses. Emperors rose and fell within months, and at the heart of the chaos was the broken coinage system. Taxes were collected in worthless money. Farmers abandoned their fields. Trade collapsed. The Roman economy was on the brink. Emperor Diocletian tried to fix it in AD 301. He issued the edict on maximum prices, setting fixed prices for thousands of goods and threatening violators with death. But it changed nothing. Because when money itself is worthless, fixing prices is like trying to hold water in your hands. The black market exploded, official trade died out, and people learned once again, no law can save a broken currency. Eventually, Rome gave up. The denarius died, replaced by Constantine's new gold coin, the solidus. That system lasted for centuries in Byzantium, but for the Western Roman Empire it was already too late. The economy had collapsed, the army disbanded, and trust, the foundation of everything, was gone. That's why Rome didn't fall in a day. It crumbled slowly, over generations. Now let's bring this story to today. Because this isn't just Rome's story. Every major inflation begins the same way. Governments dilute money to cover their debts. The wealthy protect themselves with real assets, and ordinary people lose everything. Take Germany after World War I. The government couldn't pay its debts, so it printed money. The result? Hyperinflation in 1923. A loaf of bread went from 1 mark to 200 billion marks. People carried their wages in wheelbarrows. Retirees lost their life savings. And that despair paved the way for Hitler's rise. In the 2000s, Zimbabwe repeated the same mistake. They printed and printed and printed. By 2008, inflation hit 89.7 sextillion%. Prices doubled almost daily. The country eventually abandoned its own currency. People started trading in US dollars instead. History had repeated itself once again. But this isn't their problem. Even today, developed countries follow the same pattern. In 1971, Nixon took the dollar off the gold standard. From that moment, the dollar's value depended solely on the government's promise. And guess what happened next? Money supply exploded, debt soared, and prices crept up. A 1971 dollar now has the buying power of about $6 today. The bills look the same. They're just worth less. Governments call it growth. They say wages are rising, but prices rise faster. They say it's investment, but it's mostly consumption. They say the stock market's up, but most people don't even own stocks. Just like the Roman emperors once said, everything's fine, while quietly draining value from everyone's pockets. The difference now, the system is global. Rome's collapse ended one empire. Weimar Germany's collapse was national, Zimbabwe's was local. But today the whole world plays the same game. Fiat currencies, massive debts, and central banks printing trillions. When the next collapse comes, no one will be untouched. So what can we, as individuals, do? First, inflation isn't an accident, it's policy. Second, real wealth isn't in paper, it's in land, skills, and production. Third, no system lasts forever. Romans once said, "Our money will always be worth something." Well, we know how that ended. History shows the same pattern every time. Financial systems decay slowly, then fail suddenly. When money loses its reality, society unravels. Contracts break down, trade stops, armies desert, and governments lose legitimacy. Barbarians only strike the final blow. But the fatal wound always comes from within. And here's the final thought. History doesn't repeat exactly, but if you don't understand it, it crushes you. Rome's fall wasn't just about bad emperors, it was about the abuse of money. And that story isn't over yet. If this made you think, subscribe. History already gave the answers. I'll just show you where to look.